Welcome to Today Finance at Sketching Finance. I'm James, bringing you the latest market updates and expert analysis. Let's dive in. As we stand on the threshold of 2026, the financial world isn't just changing, it's being violently reshaped. From the $204 crash in gold to the $4.5 trillion merger mania, the rules you learned in the last decade are officially obsolete. On December 30th, the market sent a signal, a warning to the unprepared, and a golden invitation to those who can read between the headlines. Today, we strip away the noise and the hype. We are delving into the 5 critical sectors that will shape your wealth in 2026. Whether it's the energy crisis fueled by AI or the consolidation of Wall Street's wealth giants, you're about to get the professional playbook. Stay until the end, because the shift from expectations to real revenue starts now. On December 30th, the safe haven of gold suffered a massive structural blow. Prices plummeted by $204 in a single session, landing at $4,325 per ounce. For many retail investors, this was a panic-inducing sell-off, but for professionals, it was a textbook example of late-cycle profit-taking. This isn't just about the price of a metal. It's about the rotation of global capital as funds liquidate their winning positions to reallocate for the 2026 AI surge. This metal sell-off marks a critical psychological pivot. When gold falls this sharply alongside major equity indices, it signals a risk-on rotation in the making. Investors are no longer just hiding, they are preparing to strike. As we display on your screen, the massive volume behind this drop suggests that large institutional players are flushing out the weak hands before the next macroeconomic cycle begins. Why did mining giants like Newmont drop over 5.6% while the metal dropped less? Welcome to the brutal world of operating leverage. Mining companies have fixed costs, labor, equipment, and energy. When the spot price of gold drops even a fraction, the net profit margin is crushed. This is why miners act like a triple leveraged bet on the metal itself. And in late 2025, that leverage worked against the bulls. Understanding the all-in sustaining cost, or AISC, is your secret weapon. If a company like Freeport-McMoRan has an AISC of $2,500 and gold drops from $4,500 to $4,300, they didn't just lose $200 in value, they lost a massive chunk of their free cash flow. This is the current reality for Newmont and Southern Copper. The market is pricing in a 2026 where operational costs rise due to energy spikes, while selling prices retreat from historical highs. The pressure isn't limited to gold. Silver, the restless cousin of the precious metals family, is facing an even more volatile correction. After hitting record highs last week, silver futures are retreating under the weight of industrial uncertainty. The gold-to-silver ratio is currently in a state of flux, indicating that the industrial appetite for silver in solar and AI may be pausing before the next legislative push in Washington. This silver sell-off is a warning sign for the broader industrial sector. Unlike gold, which is a pure monetary play, silver lives in our gadgets and green infrastructure. When silver prices drop, the market is asking a tough question. Is the green energy transition slowing down, or is this just a momentary pause before the 2026 acceleration? For the savvy investor, this pullback presents the first genuine opportunity to acquire the AI infrastructure metal at a discount. Let's talk about the year-end liquidation. In the final days of December, funds perform what we call window dressing. They sell their best-performing assets, such as gold and silver, to lock in profits and make their annual reports appear more impressive to clients. This $204 drop is the ultimate institutional house cleaning. They aren't leaving gold forever. They are just clearing the decks for a fresh start in the first quarter of 2026. This liquidity event is a gift for those with a long-term horizon. While retail investors panic sell, the smart money is watching the $4,200 support level like a hawk. Historical data show that major price resets at the end of the year often lead to a January effect rebound. If gold holds its ground at these levels, it will confirm that the bull market isn't dead. It's just transitioning from a panic hedge to a diversified asset class. Technical analysis is now the driver. Gold breaking through the previous support levels has triggered thousands of automated sell orders. We are looking at a classic flush. The next psychological floor is $4,200. As an investor, your job is to ignore the headlines and watch the volume at these levels. A high-volume bounce at $4,200 would be the ultimate buy signal for a 2026 recovery. For companies like Newmont and Southern Copper, the focus for 2026 will be efficiency. If they can lower their AISC while the market stabilizes, their stock price recovery will be twice as fast as the metal itself. This is where the real money is made, not in the frenzy of the highs, but in the calculated entries of the lows. Master the AISC formula on your screen, and you master the mining sector. While you were watching gold, a massive consolidation was happening in the wealth management industry. Small, independent firms are being swallowed by national giants at an unprecedented rate. This isn't just about size, it's a battle for asset dominance. As we enter 2026, the era of the boutique advisor is ending, replaced by a new cadre of national competitors armed with massive balance sheets and AI tools. According to the Wall Street Journal, this absorption of smaller firms is creating a new hierarchy on Wall Street. These national giants can offer everything from private equity access to tax loss harvesting at a scale that local firms simply can't match. For investors, this means your personal advisor is now part of a global machine. The synergy of these deals is designed to lower overhead and maximize the yield on AUM, or assets under management. The secret engine behind this M&A fever is artificial intelligence. Large firms are acquiring or taking over smaller firms to gain their client data, which they then feed into sophisticated AI models. This allows one advisor to handle 1,000 clients with the same level of personalization that used to require 10 advisors. It is the ultimate scaling play. The goal? To turn wealth management from a labor-intensive service into a high-margin tech business. For the investor, this is a double-edged sword. You get access to institutional-grade tools and better apps, but you lose the human alpha. The firms winning this race are the ones who can balance tech with trust. Watch the AUM yield formula. If a firm's fees are dropping while their assets are growing, it means their AI is successfully driving efficiency. This is the new benchmark for a buy rating in the financial sector. The regulatory landscape is the silent catalyst. Under the 2026 administration, we are seeing a massive push for deregulation. Rules that once made it difficult for large banks to buy small advisors are being quietly dismantled. This is the Trump 2.0 effect in action. It's a green light for consolidation, allowing firms like Morgan Stanley or Goldman Sachs to expand their reach into every corner of middle-market America. This deregulation means more options for you, but also less oversight. The firms being acquired are often those with loyal, high-net-worth clients who are hungry for more sophisticated products like private credit and hedge fund access. By merging, these firms can bring Wall Street secrets to Main Street. For the savvy investor, the stock play here is to buy the consolidators, the giants doing the buying, not the ones being bought. We are entering the age of the wealth management supergiants. This creates a new kind of systemic risk. If a national competitor manages $10 trillion in private assets and their AI algorithm makes a mistake, the ripple effect across the U.S. economy would be catastrophic. The market is currently ignoring this risk in favor of short-term growth. But as an investor, you must watch the concentration ratio of these firms. The firms that will lead in 2026 are those investing heavily in cyber resilience. As they consolidate, they become bigger targets for hackers. A single breach at a merged giant could wipe out billions in market value. This is why we look for firms that spend at least 15% of their capex on security. Consolidation is great for the bottom line, but only if the fortress is impregnable. How do you identify the winners? Look for value synergy. A successful M&A deal in 2026 should do more than just add assets. It should lower the cost per account. If the acquiring firm can successfully migrate thousands of new clients onto their AI platform without increasing their headcount, that is a massive win for shareholders. This is the efficiency frontier of the 2026 financial market. In conclusion, the wealth management sector is being techified. The stocks to watch are the ones that are aggressively acquiring, buying up, smaller firms to fuel their AI engines. This is a scale game. If you aren't the biggest, you're lunch. As we display on screen, the EV/EBITDA multiples for these consolidators are rising, reflecting the market's belief that wealth management is the next great AI frontier. Now, let's look at the physical bottleneck of the AI revolution: energy. While everyone is discussing software, the real crisis lies in the power grid. Most Americans are already paying more for electricity, and prices are set to skyrocket. This isn't just about your home bill. It's about the fact that AI data centers consume more electricity than entire mid-sized cities. The power grid is the invisible wall that could stop the AI boom in its tracks. This energy spike is driven by three key factors: aging infrastructure, the sudden surge in demand from AI, and the transition to green energy. According to the Wall Street Journal, factors beyond data centers, such as the cost of upgrading the national grid, are also driving rates higher. For investors, this is a revaluation moment. The utility companies, utilities, that were once boring dividend stocks are now becoming growth plays in the AI ecosystem. The winners in this space are the independent power producers. Look at companies like Constellation Energy, CEG. They own nuclear plants that can provide 24/7 clean power directly to AI giants like Microsoft and Amazon. By bypassing the public grid, they avoid the infrastructure surcharges and can command premium prices. This is the most elite business model in energy right now: private nuclear for private AI. These firms have what we call pricing power. Because AI companies must have the power to run their models, they are willing to pay almost any price to secure it. This is why CEG and similar stocks have outperformed the broader market. As an investor, your formula to watch is PUE, power usage effectiveness. The lower the PUE of the data centers these companies serve, the more profitable the energy contract becomes for the provider. How does this affect the big tech giants? Energy is now one of their largest OPEX, or operating expenses. Every time you ask ChatGPT a question, it costs more in electricity than a standard Google search. This energy tax is eating into their margins. To survive, big tech will have to do two things: build its own power plants and pass the costs on to you. Expect AI subscription prices to rise in 2026. This is the monetization gap. If big tech can't convince users to pay for the rising energy costs, their stock prices will suffer. This is why we are shifting our focus from the software to the hardware and infrastructure. The energy crisis is making the AI revolution real. It's no longer just code in the cloud. It's coal, gas, and nuclear atoms in the physical world. Follow the atoms and you'll find the profit. Don't just buy the power plants, buy the efficiency kings. Companies like Vertiv, VRT, and Eaton, ETN, provide the cooling systems and electrical switchgear that keep AI centers from melting down. They are the picks and shovels of the energy crisis. As electricity prices rise, the demand for efficiency tech, which can save a data center 20% on its power bill, becomes an absolute necessity, not a luxury. These companies have massive backlogs, orders that will take years to fill. This provides revenue visibility that is rare in the tech world. In a high interest rate environment, Investors love companies with guaranteed future cash flow. Vertiv and Eaton are the silent winners of the AI energy war. While everyone is betting on the next AI app, the smart money is betting on the cooling fans and transformers that make the app possible. We are also seeing a geographic shift in the AI industry. Data centers are moving to where the power is cheap and the regulations are light. This is why real estate in energy hubs is becoming more valuable than real estate in Silicon Valley. The data center REITs, real estate investment trusts, that own land near power sources are the true landlords of the AI era. In summary, energy is the new gold. The spike in electricity prices is a clear signal that the AI revolution has reached its physical limits. The investors who win in 2026 will be those who recognize that utility stocks are now tech stocks. Displayed on your screen is the PUE formula. Use it to identify which data centers and energy providers are operating at peak efficiency. In a world of expensive power, efficiency is the only way to protect your profit. Let's talk about the backbone of the market, AI infrastructure. On December 30th, SoftBank made a massive move, acquiring private equity firm DigitalBridge for $4 billion. This deal, valued at $16 per share, is a loud signal from Masayoshi Son. The future of wealth isn't in the AI software, it's in the physical data centers and fiber optics that carry it. This sets a new valuation floor for the entire sector. This $4 billion deal shows that institutional money is pouring into the plumbing of the AI world. DigitalBridge focuses specifically on the infrastructure needed to support 2026-level AI models. For investors, this means the AI hype is being replaced by AI assets. SoftBank's willingness to pay a premium for DigitalBridge proves that in 2026, the physical assets are more valuable than the speculative code. Why are experts still positive for 2026 despite the year-end dip? Because 2026 is the year of monetization. For the last 2 years, companies have been testing AI. In 2026, they are starting to generate real revenue. We are moving from the investment phase to the return phase. This is why USA Today reports that AI remains the backbone of the market optimism. The key for you as an investor is to stop looking for growth at any price and start looking for free cash flow, FCF. The companies that will lead in 2026 are those that have successfully integrated AI to lower their costs and increase their sales. This is the shift from AI speculation to AI industrialization. The backbone of the market is strong because it's finally built on real dollars, not just dreams. How should you allocate your capital in 2026? We suggest the 40-30-30 rule. 40% in semiconductors, the brain. 30% in infrastructure, such as data centers and energy, the body. And 30% in software applications, the voice. This diversified approach protects you from a chip glut while ensuring you benefit from the entire ecosystem. This is the professional's allocation for the AI backbone market. Semis like Nvidia are still important, but the infrastructure segment, represented by the SoftBank DigitalBridge deal, is where the real stability lies. As we enter 2026, the software segment will be the most volatile as companies compete to see whose AI app actually works. By holding the backbone, infrastructure, and chips, you are the house in the casino. You win regardless of which app becomes the next TikTok. There is a risk, the last mile of inflation. As we reported, rising energy prices and the battle for AI talent are keeping inflation sticky. If the AI boom gets too hot, the Fed might keep interest rates higher for longer. This is the caution mentioned by experts. High rates are the gravity that pulls down high-tech valuations. You must watch the EV/EBITDA multiple on your screen. If a company's EV/EBITDA is over 40x in a 4.5% interest rate environment, they are overvalued unless they can double their revenue in 12 months. The backbone of the market is strong, but it's not invincible. 2026 will reward the disciplined investor, Those who buy AI assets when the multiples make sense, not just when the news is good. SoftBank paid $16 for Digital Bridge because the math worked, not because it was trendy. How to spot the fakes? In 2026, we look for AI margin expansion. If a company claims to be an AI leader, but their profit margins are shrinking, they are AI washing, just using the buzzword to trick investors. The backbone of the market consists of companies that utilize AI to generate more revenue with fewer personnel. This is the ultimate test of the 2026 bull market. In conclusion, AI is no longer a niche tech sector. It is the infrastructure of the entire US stock market. The SoftBank deal is just the first of many. As we display the FCF yield formula, remember, in 2026, cash is king. The backbone of your portfolio should be companies with real infrastructure, real energy access, and real AI revenue. The hype is over. The business of AI has begun. Finally, let's look at the defensive engine, geopolitics and oil. Despite the peace talks in Florida, oil futures rose on December 30th. Why? Because peace is fragile. Russia's accusations against Ukraine created a risk premium, a fear that even with a deal, the energy supply is not safe. For the investor, oil is the hedge that protects you if the AI tech boom hits a geopolitical wall. Geopolitics is the ultimate volatility driver. As talks continue, any rumor of a setback sends oil prices higher. This is why energy companies like Devon Energy and Diamondback Energy rose by 1.4% and 1.5%, while the rest of the market fell. They are the safety net. When the world is uncertain, capital flows into the one thing everyone still needs: energy. Companies like Devon and Diamondback are free cash flow machines. At $70 to $80 oil, these firms generate massive amounts of cash that they return to you through dividends. In 2026, they are the defensive anchor. While tech stocks rely on future growth, energy stocks rely on current cash flow. This is the FCF yield play. If you can get a 7% yield from an oil company while waiting for the AI market to stabilize, you're winning the game. These companies are also incredibly efficient. After years of being ignored by Wall Street, they have lowered their break-even price. They can make money even if oil drops to $40. At current prices, they are value traps for the shorts and gold mines for the patient. As we enter 2026, these are the safe havens that will protect your portfolio from the volatility of the peace talks. So, what is the master plan for 2026? You must be a hybrid investor. You need the growth of AI infrastructure, the stability of consolidated wealth management, and the defensive hedge of energy. The December 30th sell-off in metals was just a reset. The spike in electricity prices is a call for efficiency. The SoftBank deal is a roadmap for infrastructure. And the oil rise is a reminder that the world is still a dangerous place. Diversification isn't just about owning different stocks. It's about owning different realities. Own the code, AI. Own the atoms, energy, oil. And own the pipes, infrastructure. This is how you navigate the 2026 financial shifts. Use the formulas on your screen, AISC, PUE, and FCF yield, to filter out the noise. The data is clear. The boom of 2026 will belong to the disciplined, not the desperate. Your final takeaway for 2026. Watch the Energy AI Nexus. This is where the most money will be made. The companies that solve the power crisis for AI will be the legends of this decade. Don't just watch the stock price, watch the power contracts. As for metals, the metals sell-off is your opportunity to enter. Don't be afraid of the red days. They are the foundation of your future green years. Master the EV/EBITDA multiple and don't overpay for hype. Market optimism is real because monetization is real. SoftBank's $4 billion move is just the beginning. The 2026 financial map is being redrawn by atoms, energy, and AI revenue. Stay focused on the fundamentals and let the volatility work for you, not against you. Thank you for joining us on this deep dive into the 2026 financial frontier. The earthquake has started, but you now have the playbook to find solid ground. If you found this professional analysis valuable, hit the like button and subscribe for daily updates on the shifts that will define your wealth. The era of simple investing is over. Welcome to the era of strategic dominance. We'll see you in the next deep dive. Master your money, master the future. Click the notification bell so you never miss a market pivot. Goodbye for now, and let's make 2026 your most profitable year yet.